Welcome to the deep dive. You're here because, well, you need to get smart on something important and fast.
Yeah, time's valuable.
Exactly. So today, we're tackling a really crucial part of understanding financial statements. It's about how auditors deal with and, importantly, report on last year's numbers when they're shown right alongside this year's.
Right, the comparisons.
Think of it as getting the inside scoop, maybe, on how that financial story unfolds over time, but specifically through the auditor's eyes.
Exactly.
Yeah.
And we're going to zero in on a specific standard. It's called International Standard on Auditing 710, ISA 710.
Okay.
You could think of this as the auditor's playbook, really, for handling comparative information. That means corresponding figures and comparative financial statements.
Gotcha.
We've, looked at the standard itself, and our aim here is to pull out what really matters for someone trying to understand these reports.
Like, what are auditors actually looking for when they see those prior year numbers?
Precisely. And how does their report kind of signal anything important about that past information? By the end of this, you should have a much clearer picture. It's a vital aspect of financial reporting.
Okay, let's unpack this then. Right away, the standard talks about two main ways this prior year info shows up: corresponding figures and comparative financial statements.
Yeah, that's the first hurdle.
So what's the difference? And maybe more importantly for us, what should we understand about how auditors treat them differently?
Okay, good question. It's a key distinction. So corresponding figures.
Right.
Think of them like the prior year's highlights reel.
Okay.
They're embedded right within the current year's financial statements, usually in columns right next to the current year numbers for easy comparison.
Side by side.
Exactly. Now, here's the crucial bit for understanding the audit report. When an auditor gives their opinion on the current year's financials, that opinion also implicitly covers those corresponding figures because they're presented as part of the current year's package.
Yeah.
They're intertwined.
Ah, okay. So if I'm looking at the income statement for, say, 2024, and the 2023 numbers are right next to it, those are the corresponding figures.
Yep.
And a clean audit opinion on 2024 basically gives a thumbs up to those 2023 numbers as well, at least in that comparative context.
That's it, precisely. Now, comparative financial statements, that's a bit different. It's more like getting the full movie for both years.
The full movie.
Yeah, so here, the prior year's complete financial statements, balance sheet, income statement, cash flow, the whole shebang,
Right.
are presented right next to the current year's full set, as separate complete sets.
Okay, so two distinct sets of statements just presented together.
Correct. And the big difference for you, the reader, is that the auditor's opinion then applies to each period presented individually.
Oh, okay. So they're offering an opinion on the 2023 financials as like a standalone set,
Right.
and then a separate opinion on the 2024 financials.
Exactly right. So this can give you a much more direct sense of the auditor's view on each individual year, not just the current one.
Got it. So with comparative financial statements, it's almost like getting two audit opinions reflected in the one report, in a way.
Sorta, yes. The report structure reflects opinions on each period presented.
And I see a note here that the actual rules for how this comparative info is shown, like whether it's just key figures or full statements, that's actually dictated by the accounting rules the company follows.
Spot on, like IFRS or local GAAP, whatever their applicable financial reporting framework is.
So the auditor doesn't decide how it's presented.
No.
They just check if it's done correctly according to those rules.
Exactly right. The auditor's role isn't setting the presentation format. It's assessing if the chosen format follows the relevant accounting standards properly.
Okay, so with that fundamental difference, clear corresponding figures versus comparative statements, what's the auditor really trying to, well, nail down when they look at this past information? What's their main goal here? For us, I mean, the users of these reports.
Good question. The primary objective, the main thing, is to get enough solid evidence, sufficient appropriate audit evidence, in audit speak,
Right.
to be reasonably confident that the comparative information, whichever form it takes, has been presented fairly,
Fairly.
meaning it's not misleading and it complies with the accounting rules. And importantly, in all material respects.
Material, meaning big enough to matter. Like it could actually sway decisions someone makes based on these financials.
Exactly that. It has to be significant enough to potentially influence a user's economic decisions.
So basically, they want to make sure last year's numbers shown alongside this year's give us a true and accurate picture for that comparison. So we're not basing decisions on, shaky data from the past.
Precisely. And then kind of a secondary objective, but flowing directly from that, is for the auditor to then report on this clearly
Yeah.
based on what they found.
Okay.
We'll definitely dig into the reporting specifics later, but the foundation is always getting that assurance first about the reliability of those comparative numbers.
All right. So how do they actually get that assurance? What kind of steps are they taking when they look at last year's data next to this year's?
Well, there are several important steps involved. First, the auditor has to check that the comparative information actually agrees with the amounts and the disclosures that were presented in the prior period's financial statements.
Like a reconciliation, making sure the numbers haven't just been plucked out of thin air for the comparison.
Exactly. It's a meticulous cross-referencing exercise. They're not just taking the current presentation at face value for the prior year's numbers. They should be tying it back to the prior period's audited or unaudited figures.
So checking the source makes sense. What else?
They're also looking very carefully to see if the accounting policies, the methods used this year, are the same as those used last year.
Ah, consistency.
Yes, consistency is absolutely crucial for making meaningful comparisons over time.
Because I guess if a company suddenly changes how it recognizes revenue or values inventory or something,
Yeah.
then just comparing this year's number to last year's might be totally misleading, wouldn't it? Unless that change is handled properly.
Precisely. So if there have been changes in accounting policies, the auditor digs in. They scrutinize whether those changes are, 1, properly accounted for according to the rules, and 2, adequately presented and disclosed.
So explained clearly in the notes.
Yes, explained clearly. And this includes making sure that if prior year figures needed to be adjusted or restated because of that policy change, that was done accurately.
Okay. Now, here's a twist I was thinking about. What if the financial statements for last year weren't even audited? Or maybe they were audited, but by a completely different firm? The standard calls them the predecessor auditor, right?
Yep, predecessor auditor.
How does that change things for the current auditor looking at those comparisons?
Yeah, these situations definitely add layers of complexity. So if a predecessor auditor did audit the prior year,
Okay.
the current auditor will carefully review that predecessor's audit report.
Read their notes, basically.
Essentially, yes. And if that prior report had any modifications, maybe it wasn't a clean opinion, perhaps it was a qualified opinion pointing out a specific problem.
Like they couldn't verify inventory levels or something?
Exactly, something like that. Well, that's a big signal the current auditor needs to pay close attention to.
Why? Because the old problem might still be relevant.
It could be. The issue that caused that prior modification might still have implications for the current year's numbers, or at least for how the comparative figures are presented and understood.
So for us reading the report, a modified opinion on the prior year is like a little red flag, maybe, worth noting even if the current year gets a clean bill of health.
Absolutely, it's context.
Yeah.
So a problem from the past, even under a different auditor's watch, isn't just forgotten. It needs to be considered in the current audit.
Okay. What about the other scenario? What if the prior year was completely unaudited? That sounds like it would require a whole different level of scrutiny.
It does, yeah. In that case, the current auditor doesn't have the benefit of any prior audit opinion to lean on for those previous year's figures.
So more work for them.
Potentially, yes. They
Good.
still have to perform procedures to get enough reliable evidence about those corresponding figures or comparative financial statements. This could mean doing more, maybe significantly more, in-depth testing of the prior year's account balances and transactions than they might otherwise.
Okay, so whether there was a prior audit by them, by someone else, or no audit at all, the current auditor always has a responsibility to do their homework on those comparative numbers.
That's the bottom line, yes.
Okay, now let's talk about where the rubber meets the road for us, the auditor's report, the thing we actually get to read. How does all this thinking about prior year data actually influence what the auditor says in their report? Let's start with the first type, when we just have those corresponding figures.
Okay, so when we're dealing with corresponding figures, if the auditor gave the prior period a clean opinion, what we call an unmodified opinion,
The standard thumbs up.
right, and those figures are presented appropriately within the current year's financials,
Yeah.
no issues there, then the auditor's report on the current year usually won't specifically mention those corresponding figures in the main opinion paragraph,
Why not?
because they're just seen as part of the historical context for the current year's figures, which are being opined on. The focus is the current year.
So if everything was fine last year and the comparison looks okay this year, the auditor just concentrates on the current year in their main opinion statement.
Generally, yes.
Yeah.
However, and this is important, if the auditor did have to modify their opinion on the prior period.
Ah,
Yeah.
okay. The inventory example again.
Let's use that. Maybe they had to qualify their opinion last year because of a problem with how inventory was valued. Then the current auditor's report needs to bring this to your attention as the reader.
How do they do that without messing up the current year's opinion?
They would typically do this in a separate section of the report. Often it's called an other matters paragraph.
Other matters, like a PS from the auditor.
Kind of. Think of it as a special note flagging something important you should be aware of, even if it doesn't change their main opinion on the current year's financials directly.
And in that paragraph.
They'd explain the original issue, the inventory problem from last year, and explain how it might still affect the comparability or understanding of the corresponding figures being shown now.
That makes a lot of sense. You wouldn't want someone looking at, say, a really positive current year result without knowing there was a significant issue clouding the prior year number they're comparing it to.
Exactly. Transparency.
What if it was the predecessor auditor who had that modified opinion last year? Does the current auditor still mention it?
Yes, they do. If a predecessor auditor issued a modified report, and the reason for that modification is still relevant to the current financial statements or the corresponding figures.
Still relevant, meaning the problem wasn't fixed or still affects the trend.
Could be either. Or just that the context is important for understanding the comparison. In that case, the current auditor also needs to mention that in their report.
Same place. That other matter paragraph.
Usually, yes. Again, giving you the background on that prior audited opinion, the key takeaway here is that a past problem, even under a different auditor's watch, doesn't just vanish from the record if it's still relevant. It has to be acknowledged.
Okay. And the final scenario for corresponding figures. What if the prior year's financials were never audited in the first place? How does the current auditor let us know about that?
Ah, yes. In that case, the current auditor is required to state, again, usually in an other matters paragraph, that the corresponding figures are unaudited.
Just flat out state it.
Yes. The corresponding figures presented for the year ended prior year-end date were not audited. Something like that.
And that's crucial information, right? Because it tells you those prior year numbers haven't been independently checked to the same degree as the current year's figure.
Absolutely. It sets the right expectation about the level of assurance attached to those numbers.
Okay, so the reporting on corresponding figures really hinges on whether there were any issues flagged in the prior period by the current auditor, a predecessor, or if there was no audit at all.
That's a good summary of it.
Now let's switch gears to the other type, comparative financial statements, where we see those full sets of financials for multiple years side by side. How does the reporting work there? It sounds like it might be more direct.
It is, generally. With comparative financial statements, remember, the auditor's opinion explicitly covers each period presented.
Right, you said that. So the opinion paragraph itself will address both years.
Correct. So you might see wording that clearly states whether the 2024 financials are fairly presented, and then separately states whether the 2023 financials are also fairly presented.
Okay, so it's very clear. A distinct opinion on each year included in the comparison.
Exactly. It gives you that clear, distinct view of the audit opinion on each year's full set of statements.
But what if the auditor's opinion on one of those years is different from the other? Like maybe last year was clean, but this year they found a problem and had to qualify the opinion. Or the other way around.
Yeah, that happens. And it's a very important point for reporting. If the opinion on the prior period's financial statements differs from the opinion on the current period, the auditor absolutely has to explain the reasons for this difference in their report.
So they have to spell out why the opinions don't match.
Yes. For instance, let's say the prior period had a qualified opinion, maybe because of that inventory issue again. But the company fixed the problem in the current year.
Okay.
The auditor would likely issue a clean, unmodified opinion on the current year, but they would explain in the report why the prior year opinion was qualified and that the matter has now been resolved.
Ah, so it tells the story of the resolution.
Exactly. And conversely, if the current period's opinion is modified, maybe a new problem popped up while the prior year had a clean opinion that also requires a clear explanation, highlighting the new issue.
So it's all about giving the reader a complete and transparent picture across all the years being presented.
That's the goal, full transparency.
It really sounds like the auditor's report becomes more of a narrative in this case, doesn't it? A narrative of the company's financial reporting journey over the presented periods, highlighting any big changes or bumps in the road as seen by the auditor.
That's a great way to put it. It's seen through the audit lens, yes.
Now, what about the predecessor auditor situation here? With comparative financial statements. If someone else audited last year, how does the current auditor acknowledge their work?
Okay, so if the prior period was audited by a predecessor auditor who issued an unmodified report, a clean opinion,
Everything was fine.
right, then the current auditor's report generally doesn't need to refer to the predecessor auditor at all.
Really. They just give their opinion on both years as if they audited both.
Not quite. They only opine on the years they audited. But if the predecessor gave a clean opinion on the prior year presented, and the current auditor is also giving a clean opinion on the current year, there's usually no specific mention needed about the predecessor in the main body. The focus remains on the fairness of the presented statements for each period.
Okay. But I'm guessing if the predecessor's report was modified, or if there's some kind of unresolved issue lingering from that prior period, then the current auditor has to say something, right?
Absolutely, you guessed right. If the predecessor auditor issued a modified opinion, or R, if a significant problem, a misstatement, from a prior period is discovered in the current year and the prior year's financial statements are not restated to fix it.
Which can happen.
It can, though ideally they should be restated. But if they aren't, then the current auditor needs to address this in their report. They have a responsibility to make the reader aware of these known, unresolved past issues, even if it wasn't their audit that found them initially.
So even though they didn't do that prior audit, the current auditor is still kind of looking out for us, the users, by flagging any significant unresolved historical issues that affect the comparative statements.
Exactly. Protecting the user's understanding.
How do they actually do that, though, if they're not reissuing the predecessor's report or anything?
In these specific situations, like a prior modification by a predecessor or an uncorrected prior period misstatement affecting the comparatives, the current auditor's report will again include that helpful other matter paragraph.
Ah, the other matter paragraph writes again.
It's a useful tool.
Yeah.
This paragraph will typically state that the prior period financial statements were audited by another auditor. It will usually give the date of that predecessor's report, the type of opinion the predecessor gave, unmodified, qualified, adverse, disclaimer.
Okay.
And importantly, if the opinion was modified, it will also explain the reasons why.
So you get the full context. You know who audited before, when, what they thought, and if there were any problems highlighted.
Precisely. It ensures you have the necessary context about the reliability and audit history of all the financial statements you're looking at in that comparative presentation.
Wow, this is actually really detailed and helpful. It sounds like auditors have to navigate quite a few different scenarios when they're dealing with this comparative information.
They do. It requires careful judgment.
The standard itself, ISA 710, must have some concrete examples to illustrate all these different reporting situations, right? It sounds complicated.
It does, thankfully. The appendix to ISA 710 provides several illustrative examples of independent auditors' reports. They cover various scenarios.
Like what?
Well, for instance, there's a scenario showing a presentation with corresponding figures where the prior period had a qualified opinion because of, let's stick with inventory valuation issues.
Yeah.
The example shows exactly how the current auditor would word that other matter paragraph to explain the prior qualification and how it might still be relevant to understanding the corresponding figures presented now.
So they would literally spell it out, maybe saying something like, hey, just so you know, when last year's books were audited, there were concerns about how inventory was valued, and that could still have a bearing on how you interpret these comparative figures.
Something very close to that, yes. But using the precise, standardized language required by auditing standards to ensure clarity and consistency across reports.
Gotcha. Any other examples?
Yeah, there's also a good one showing comparative financial statements where, again, the prior year had a qualified opinion, but the issue that caused it has been fully resolved in the current year.
Ah, the problem fixed scenario.
Exactly. In that case, the example shows the current auditor would likely give a clean, unmodified opinion on the current year's statements, but would still reference and explain in the basis for opinion section related to the prior year that the prior year's opinion was qualified and briefly why, noting the matter is now resolved.
It really sounds like the auditor's report, when you know what to look for, is way more than just a simple pass-fail grade.
Oh, absolutely.
It's actually telling a story, isn't it? A story about the financial data across time, highlighting any important events, changes, or concerns along the way.
That's a perfect way to describe it. It provides vital context, context that helps you, the reader, understand the reliability and, crucially, the consistency of the financial information being presented year after year.
Okay, so let's try and bring it all together then. Our deep dive into ISA 710. It seems to have revealed that when you see those prior year numbers popping up in financial statements,
Uh-huh.
the auditor isn't just giving them a quick glance, not at all. They have very specific rules and procedures they follow.
Right.
And it depends, as we discuss, whether it's just a few corresponding figures embedded in the current statements or that full set of comparative financial statements.
Approach differs, yes.
And crucially, their report, The Thing We Read, is designed to flag any significant issues from prior periods, whether it was the current auditor who found them or a predecessor auditor, or even if there was no audit at all last year.
That's a perfect summary. And understanding these maybe subtle nuances really helps you, as a user of financial statements, recognize that the auditor's report offers so much more than just an opinion on the current year in isolation.
Yeah.
It gives you a really valuable perspective on the financial history and the consistency, or maybe lack thereof, of a company's reporting over time.
So, building on that, here's maybe a final thought for everyone listening to consider. Now that you have this understanding of the auditor's approach to comparative information, how can that sharpen your own analysis? Your analysis of a company's financial performance and its trends?
Good question.
When you're reviewing those annual reports, the ones with multiple years of data laid out, what new questions might you ask yourself now? Questions about the numbers, sure, but also about the auditor's opinion on them, both for the past and the present.
Yeah, what might you look for between the lines now?
Exactly. It feels like a deeper level of financial insight, and it's definitely worth pursuing. Thanks for joining us on this deep dive.